Have you ever stopped to think about what money really is? It's not just paper and metal, and it's definitely not just numbers on a screen. The story of money is the story of human civilization itself, a tale of trust, innovation, and power. So, how did we go from trading a handful of grain to a global financial system that never sleeps? Let's find out. Long before the first coin was ever minted, people used barter. Imagine you're a farmer with a surplus of wheat, but you need a new pair of shoes. You'd have to find a shoemaker who not only wants your wheat, but also has the exact shoes you need in your size. It's what economists call the double coincidence of wants, and it's incredibly inefficient. You might have to trade your wheat for some pottery first, then trade the pottery for a tool, and then finally trade the tool for the shoes. It was complicated and made large-scale trade almost impossible. To solve this, societies naturally started using commodity money. These were items that everyone agreed had value. In ancient China, it was cowrie shells. In parts of Africa, salt blocks were the currency of choice. The Aztecs used cocoa beans. Imagine buying your lunch with a handful of chocolate. These items were more convenient than bartering because they were generally accepted, durable, and relatively easy to carry. But they still had problems. Salt can get wet, grain can spoil, and carrying around hundreds of shells isn't exactly practical. Plus, how do you make change? You can't exactly break a cow in half. This led to the next big leap: metal. People began using valuable metals like gold, silver, and copper. At first, they were just lumps and chunks, traded by weight. You'd have to carry a scale everywhere to make sure you weren't getting ripped off. Around 600 BC, the Kingdom of Lydia, in modern-day Turkey, had a brilliant idea. They started stamping POI pieces of a gold and silver alloy called electrum with an official seal. These were the world's first coins. The stamp was a guarantee from the king or the state about the weight and purity of the metal. This simple innovation revolutionized trade. Now, you could just count the coins instead of weighing them. The idea spread like wildfire across Greece, Persia, and eventually the entire world. Money was now standardized, portable, and easily recognizable. With all this valuable metal floating around, a new problem emerged. Security. Walking around with a bag full of gold coins made you a prime target for thieves. This is where the story of banking begins. In ancient temples and palaces, people would deposit their grain and precious metals for safekeeping. Priests and rulers were trusted figures, and their strongholds offered protection. In return for your deposit, you'd get a clay tablet or a papyrus receipt. Over time, these early bankers noticed something interesting. Most people didn't come back for their gold all at once. The deposits just sat there. So, they started lending out a portion of the deposited gold to others who needed it, charging interest for the loan. This was the birth of fractional reserve banking. They realized they could create more money in the form of loans than the actual gold they held in their vaults. As trade grew more sophisticated, so did banking. In medieval Italy, powerful families like the Medici became international bankers, financing kings, popes, and merchants across Europe. The word bank actually comes from the Italian word banca, which was the bench or table money changes used in the marketplace. The next major evolution was the rise of goldsmiths in 17th century London. People would deposit their gold and silver with a trusted goldsmith for safekeeping. The goldsmith would issue a paper receipt, a promise to pay the bearer that amount of gold on demand. Soon, people realized it was much easier to trade these paper receipts directly rather than going back to the goldsmith, getting the gold, and then giving it to someone else. These receipts were, in effect, the first banknotes. Goldsmiths, just like the ancient temple priests, also realized they could issue more receipts, more paper money than the gold they actually had in storage, lending out the excess at a profit. This system worked on trust, but what happens when everyone panics and wants their gold back at the same time? A bank run. The goldsmith wouldn't have enough gold, and the system would collapse. This highlighted the need for a more stable, centralized authority. Enter the central bank. The first was the Swedish Riksbank, founded in 1668, followed by the Bank of England in 1694. These institutions were created to manage the nation's money supply, act as a lender of last resort, prevent bank failures, and manage the government's finances. They were given the exclusive right to issue banknotes, which eventually became the official legal tender we know today. This was the transition from money backed by a specific commodity like gold, the gold standard, to fiat money. Fiat money is currency that a government has declared to be legal tender, but it isn't backed by a physical commodity. Its value comes from the trust and faith people have in the government that issues it. When the United States officially abandoned the gold standard in 1971, the entire world moved to a fiat system. The dollar, the euro, the yen, their value is based on the stability of their issuing governments and economies. This brings us to the modern era. The 20th and 21st centuries have seen an explosion in financial innovation. We have commercial banks for everyday transactions, investment banks that handle mergers and stock market trading, and a whole ecosystem of financial institutions. The biggest revolution, of course, has been the digital one. Money is no longer just paper or coin. For most of us, it's just data. When you get your paycheck, it's a direct deposit, numbers moving from your employer's bank account to yours. When you use a credit card or a mobile payment app, you're just sending digital signals that authorize a transfer of funds. And the evolution isn't over. We are now in the era of cryptocurrencies. In 2009, an anonymous creator known as Satoshi Nakamoto launched Bitcoin, the first decentralized digital currency. Unlike traditional money controlled by banks and governments, cryptocurrencies are secured by cryptography and run on a technology called blockchain, a distributed public ledger. This has opened up a whole new world of possibilities and debates. Could this be the future of money, a truly global, decentralized system, or is it just a speculative bubble? The jury is still out, but it's undeniable that the underlying technology is forcing us to rethink the very nature of money and trust. So, from a sack of grain to a string of code, money has constantly transformed, but its core functions have remained the same. First, it's a medium of exchange, solving that old bartering problem. Second, it's a unit of account, giving us a common measure to value goods and services. How many chickens is a car worth? It's much easier to just use dollars or euros. And third, it's a store of value, allowing us to save our purchasing power for the future, though inflation can be a challenge. The story of money is a reflection of our own journey, our quest for efficiency, our systems of trust, and our ever-changing technologies. It's not just economics, it's anthropology, politics, and technology all rolled into one. The next time you pay for your coffee, take a moment to appreciate the incredible history behind that simple transaction. What do you think is next? Will we have a single global currency? Will AI manage our finances? The one thing we know for sure is that the story of money is far from over. Thanks so much for watching. If you found this journey through time fascinating, don't forget to like this video, subscribe to the channel, and hit that notification bell so you don't miss our next exploration. See you in the next one.